Well, it's tax time again, which means you probably just wrote a check to the IRS. And your first thought was probably, ugh, this is so awful. Why do I have to keep giving the government all of my money? Followed closely by your second thought, which was probably, how do I lower my taxes next year? Well, there's only three ways to lower your taxes. The first is to make less money. And that is not an option I think anybody would like. Number two would be for the government to actually lower tax brackets. Now, we have a national debt that's through the roof and an aging population that's hanging on. Thanks, Grandma. So I don't see, and maybe I'm wrong, but I don't see really low taxes in our future. Also, in case you didn't know, taxes are actually historically lower than they've been in years. But the third way that you could pay less tax next year would be to make a contribution to some kind of tax deductible contribution. So the 401k, IRA, SEP, TSP if you work for a government entity, all of those things give you a break on your income in the year that you make the contribution. So when you contribute to your 401k, let's say you make $50,000 and you contribute 5,000, then you actually only pay tax on the 45,000 that you took home. Well, the great news is you get the deduction this year, and the entire time that it's growing, you don't have to pay taxes on it. The trouble begins that when you finally get to retirement age and you can access those dollars, which currently is 59 and a half, then that money is 100% taxable at whatever rate the taxes are at that time. Now, there's a couple of problems with this strategy, and I want to bring them to your attention. First, are you actually making the least amount of money that you're ever going to make in your lifetime? If you're in your 20s, 30s, or 40s, my guess is the answer is no, for a few reasons. You are driven and you're ambitious and you want to continue to excel and exceed in your job. So there should be some kind of an income correlation to that. But the other reason is that with inflation, we have time on our side. And because of that time, your paycheck is probably going to raise. So would you want to defer paying it on a smaller amount only to have to pay it on a larger amount later? It doesn't really seem like the best strategy. The other reason that this deferral concept is a little crazy to me is because you're putting your money in deferred now, you're letting it grow, tax deferred, but you're taking it out in the future 100% taxable. So the question is, on your $5,000 contribution, what would the taxes have been on that? Versus what is that $5,000 going to grow to over your lifetime? And then you're going to take it out later. Not only did you grow your money, but you also grew money for the government. And I don't hate them, but I don't love them enough to grow money for them. Okay, the second reason is that if you are retired, the goal is to be retired for a long time, right? You want to be able to retire 50s, 60s, 70s when you're ready for it, not because your paycheck determines when you can be ready for it. But if that's the case, longevity is on our side today. And so now people are living to their 80s, 90s, 100, which means that you will be retired for 20, 30, or 40 years. Where will taxes be? If we look back 20, 30, and 40 years, tax brackets have been all over the place. A married couple filing jointly in the 1980s, making $100,000, was in the 50% bracket. Yeah, 50%. That same couple making $100,000 now is only in the 20 to 23% bracket and probably only paying about 18% in their marginal effective taxes once all is said and done. So You're telling me that you want to defer paying taxes now for the monopoly game of who knows what it will be in the future. Okay, taxes are actually on sale. I know I said it earlier, but Trump implemented, whether you like him or not, Trump implemented a tax break. And we know that in 2026, taxes are going back up. Where they will be in the future, we have no idea. But our job is to make sure that the taxes that you pay over your lifetime are as small as possible. Maybe making those contributions and paying the tax now isn't such a bad idea. Now, I want to give you a tip with this. If we're asking you to make your tax payment now, we also are encouraging you to save for retirement. So, if we're encouraging you to save for retirement, I want to give you a little trick. A lot of companies have implemented the Roth IRA component to their 401k or TSPs, which means that the money that you put in is already been taxed. Your contribution will go on the Roth side. But they will make the match, whatever the match is. And in most companies, it's a percentage or a dollar for dollar amount. Their match will go on the other side of the tax equation because they want the benefit today. That makes sense. So that money that they contribute for you will not be taxed, will grow tax deferred, and then when you take the money out, will be 100% tax free. But in this new strategy, you have income in the future coming out on both sides of the tax fence. On the Roth side, where it will be tax free, and on the IRA side, where it will be 100% taxable. Listen, your CPA's job is to figure out how to get your lowest taxable number today. But my job is to figure out how to get the lowest taxable number over your lifetime. I want you to pay as little tax over your life as legally possible. Thanks so much. Have a great day.